Hello, everyone, and welcome to our financial webcast presented by Legend Financial Advisors, titled 2023 Financial Market Outlook, Navigating the Pitfalls and Opportunities Ahead. Today's webcast presenter is Bill Knight, CFP, AWMA, PPC, Wealth Advisor with Legend Financial Advisors. Please hold as I turn it over to Bill.
Thank you, Dan. Hello, everyone. Welcome. Bienvenidos. I hope your 2023 is off to a great start. It's certainly an eventful time of year. In the world of finance right now, we have the World Economic Forum taking place this week in Davos, Switzerland. In the world of dance, we have the World Salsa Summit in Miami, Florida. And last but not least, in the world of football, we have the NFL playoffs. And even though the Steelers didn't make it this year, they were starting to heat up towards the end of the season, and they look poised for success later this year. And I think it's safe to say that we're all hoping for a similar outcome for our investments this year. So for now, we'll put the salsa and the football aside and dive into the world of finance, and most importantly, what it means for you. So by the end of this presentation, what I want you to walk away with are two tools that you can use to seize the market opportunities ahead and avoid potential pitfalls. So I have this overview slide for the presentation, and it gives you a brief structure of how we will approach the presentation. So we're going to cover what happened last year in 2022. We're going to talk about where we are today, and then we're also going to talk about what the opportunities are that lie ahead. So let's jump right in. And really, when we first start talking about 2022, I want to give you some insight and feedback from a valuation chart that we use pretty consistently, and for our clients who join the call, they'll be familiar with this. This is a chart that anticipates what the 7-year asset class real return forecast will be for a variety of different asset classes. And this is from GMO, from Jeremy Grantham and his team. And they've done a great job of being able, based on valuations, to have a good idea of what returns will be for different asset classes. So what they were anticipating at the beginning of last year was for nearly negative returns almost across the board. And the way this is broken out is that the left side is for the stock market, the right side is for bonds as a whole, and the way that they forecast this is they give you the numbers that would be your return after inflation. So that's why it is a real return forecast. Real means after inflation. And they are assuming that inflation would be 2.2%. So what we saw for last year is that the most overvalued parts of the stock market were US large cap and US small cap. From there, for the stocks, we had better valuations, although still negative, for international large cap stocks and international small cap stocks. And then finally, for emerging markets and emerging markets value stocks, we had actual positive numbers here. And then as for the bonds, we ended up having negative numbers across the board. And really what we did with a lot of our clients a year ago and even a year and a half ago is we really tried to start limiting some of the bond exposure in the portfolios just because the expected returns were so low. And as you can see, that's changed a lot so far this year. So as I go into the next slide, this gives us an idea of what actually occurred for asset classes last year. And we really see an outperformance in 3 different indexes. The top index that we have on this illustration is actually managed futures. Now, managed futures is something that, it's this light green line. It's something that we've used in the past and we put back into the portfolios over the summer last year. And that is a trend following technique. So it's not something that's necessarily based upon favorable valuations to have an attractive return. It also provides a strong diversification in the portfolios. And it's something that we had used years ago and re-implemented into the portfolios last year. So that was the top performer. From there, we have the return for commodities. Commodities also had a very strong year. You can see that it started to fall back in performance. Part of the initial run-up was due to the war in Ukraine and how that affected energy and other precious metals. And that was, even at the end of the year, it finished up probably about 15%, a little bit less than that, but it was still one of the strong performers. In addition to that, we have the US dollar, and that was strong for most of the year. In the last quarter, it started to come back down. And aside from that, you can see that this is the return line for 0. Everything else was really negative. So we have gold right here that ended up finishing the year about break even. You have floating rate bonds that were about break even to slightly negative. And then everything else nearly here, as we look at this illustration, you're seeing from intermediate term bonds to the NASDAQ, everything was down basically 10 to over 30%. So it's interesting to see the GMO asset class return forecast. And even though that's a 7-year outlook, it did a good job having a good prediction in terms of what would occur, or at least what trends to be aware of. And then if we look at this next illustration, this actually gives a nice breakout to talk about these sectors that are in the S&P 500. So the S&P 500, broken down upon all of these sectors here, what you can immediately see is that the orange line here, this is energy. Now, energy was one of the few sectors that had a strong performance last year, and it was up over 60%, which is pretty incredible. And from there, you can see that just above break even, we have the utilities and then consumer staples, which typically when there's volatility, those 2 sectors will perform well. And then really beneath that, everything else was negative, even pushing 40% for communication services. So that's what happened last year. And I kind of want to compare and contrast that with what the expectations are now for this year, just so we can get a better feel for what has changed and what some of the trends are to be aware of in terms of where we're seeing more attractive valuations. So again, this is the 7-year real return forecast from GMO, and it's really almost a night and day comparison from 1 year ago. When you look at stocks, if you recall in the earlier slide, the returns for US large and US small were about -7, roughly -5 or -6 for small cap. And then, most of these numbers were still negative. And really what we're seeing is that the drop in the markets experienced last year in the US was one of the areas that had the highest valuations, and in particular, large cap stocks. And that's also the part of the market that took the largest fall for last year, really pushing over 30%. So that drop has helped reduce, what the expected returns are, or at least, I guess, increase what the future expected returns are. But still keep in mind that over the next 7 years, they are expecting that US large cap and US small cap will still have negative numbers over that same time frame. So what is interesting to note is that the numbers have continued to improve for international stocks as well as emerging market stocks. And in particular, there's a higher expected return for emerging value stocks. So that's from the standpoint of the stocks, a lot different from last year, similar trends, just more attractive numbers. And then for the bond side, instead of seeing everything negative here, we actually have some positive numbers. Now, again, remember, this is after inflation. So these would be positive returns above and beyond inflation. So this is for US bonds, just over 0.6%. More attractive numbers for emerging debt. And then you have US inflation-linked bonds and US cash. And we'll talk a little bit more about what the cash positions look like today, money market rates, and so on. So to start this year, just to give you an idea of what has occurred so far, we've seen a bit of a rally over the past few weeks. And what's interesting to note, and keep in mind, this is just 2 weeks. This could change largely over the next week. But what we're seeing is that a lot of the areas that we were discussing have already had pretty strong performance. And typically what you'll see after the end of a quarter or after the end of the year is there will be sector rotations. And you're starting to see that in purple here. We have the MSCI Emerging Market Index. So we're showing that with a gain of just under 8%. We're showing the gains in the Russell 2000, which is more of the small cap stocks, similar, just about 7%. And blue is the Europe, Australasia, Far East. And then we even have the REIT index. So a lot of these have been doing pretty well. Gold continues to perform well since the fourth quarter of last year. And you're starting to have rebounds in other areas like the NASDAQ, for example, and so on. So that's what we're seeing so far year to date with the limited time that we have. And then on a sector basis, you're also kind of seeing the opposite of what we experienced last year, where one of the underperformers so far this year is healthcare. That was actually one of the best performing sectors last year, and that was one of the strong parts of our portfolios for last year. On the top here, we actually have communication services, which was one of the biggest losers last year. And then consumer discretionary, which was also in a similar boat for large losses last year, over 30%, materials, and then we have real estate, and then everything else kind of falls in between. So what I'd like to segue into is some of the dangers to look out for this year. I know a lot of us are following the media, and we hear often about the possibility of recession. We've really been hearing about it since last year, and it's something that is brought up repeatedly, whether you're reading magazines, the newspaper, you're putting on the television. And one of the reasons that that is brought up so frequently is because of the current state of financial conditions. And one of those in particular is the yield curve. Now, with the yield curve, when that inverts, that is a predictor of a recession. And I'll show an illustration on the next slide, but we'll talk about that a little bit more. A few of the other items to take into consideration is we're currently in an environment where we have high interest rates, where interest rates right now are between 4.25 and 4.5%. And that has a couple different effects. For the fixed income portion of the portfolios, it has a good effect where bonds are now much more attractive. The saying goes, the Fed has put income back into fixed income. And so that's great for money market accounts, the bond portion of the portfolio. But the difficulty is the reason the Federal Reserve is raising interest rates and anticipates to continue raising interest rates at the next meeting in February and potentially in March is because they are trying to bring down inflation. And with bringing down inflation, they're also trying to increase unemployment so that they can be able to control and have more price stability. So that is something to take into consideration because ultimately that will slow the economy. Since the interest rates were so often and so large last year, there will be a trickle effect into the economy, and we won't see the impact of all of that right away. Sometimes there can be a lag of several quarters, if not more. So that's something to take into consideration, and it's also one of the points where a lot of analysts today talk about the possibility of earnings seeing declines in corporate earnings and that potentially adding some volatility for this year. The other items to be aware of, one is housing. And I bring up housing because housing is a leading indicator similar to the auto industry in terms of how the health of the economy is. And housing is currently in a recession, and part of that being housing is at nearly an all-time low for affordability. And you also have mortgage rates, which is in a similar thought, about 6.5%. So much different than a year ago. And we're seeing that trickle through and affect the economy. And from there, the other note is the savings rates are very low. And they're actually almost as low as before the Great Recession in the 2007 timeframe. And really what we saw over the past few years is that as the Federal Reserve put a lot of stimulus into the economy during the pandemic, the savings rates went to highs, and over the course of the Federal Reserve having a more restrictive monetary policy and stopping their program of buying bonds, they are now selling bonds, all in an attempt to slow down the economy. So those are things to keep into consideration. And when the savings rate is low, typical consumers will typically purchase more using their credit cards, and it's not necessarily the best time to be taking on more debt, just giving high rates. So one illustration I'd like to spend a little bit more time on to give you a visual of what I was talking about was the yield curve. And this is a graphic by the Lurk group, and this shows yield curves since February of 2021. And those are in the light gray down here. And really what you can see, a normal yield curve is one that starts down and it slopes up over time. And the basic idea is that you will be rewarded for investing in bonds of a longer duration, let's say 20, 30 years, than you would be for bonds of a 3-month maturity or a 1-year maturity. And what happens when current financial conditions worsen is you will have an inverted yield curve like we have today. So this is the current yield curve. You see this is for January of 2023. Instead of going up on a trajectory like this, you will actually see it go down. So that's where we're at right now. Now, without going into too much detail, why is this important? The reason it is important is that the yield curve has almost always predicted a recession in the next 10 to 12 months. So for last year, and this graphic down here does a good job to illustrate this over the past several decades. What we saw last year is there was an inverted yield curve. Once in April was the first one that fired, and then there was also yield curves in for actually the 10-year minus the 3-month yield curve in November of last year. So why this is important is if you compare this to history, the last 8 yield curve inversions have all predicted a recession. So we can see that if we look at the recession for July of 1990, we can see that this red area right here, this shows a yield curve inversion. And then if we fast forward to March of 2001, we can see that prior to that, we had a yield curve inversion. And then for December of 2007, we can see that prior to the recession, we had a yield curve inversion. And that prior to the quick recession in 2020 for the pandemic, we had a similar condition. And this is where we are at today. So that is really why a lot of analysts have been talking about that so heavily as we continue to have different factors in the economy that may put us into a recession. Now, there are positives. There are items like a low unemployment rate that's currently at 3.5%. That has really been kind of the shining star over the past year, and that has helped with spending. Wage growth was improving last year. So those types of items, although they add to inflation, there are positives in the economy as well. So after talking about some of those items to be aware of in terms of what the dangers are, I want to shift and talk about some of the opportunities and then look at a few illustrations to make those easier to understand. So the first one is fixed income. And just looking and comparing and contrasting right now compared to a year ago, the environment is much more attractive. And what was difficult about last year is that a traditional 60-40 portfolio had one of its worst years in history. And to give you an idea, a conventional 60-40 portfolio for last year was down 16.8%. Now, with most of our models ranged from anywhere from down about 9.5% to down about 13% for our 60-40 portfolio. But what we saw is for last year, it was only the 6th time in over 145 years that both stocks and bonds both had negative total returns. And why that is important is that for a traditional 60-40 to work is that you're expecting that either stocks or bonds will have a positive performance, and we didn't see that last year. Now, with what we saw in the GMO illustrations and what we'll see next is that fixed income is much more attractive. Next, we have equities, and value was saw a very important shift last year. And really what we saw over the past decade is growth investments outperformed value because the financing was so easy to get, because interest rates were at record lows for a long time. Financing was very cheap, so a lot of growth companies did really well. And last year, we really saw the reverse of that, with a lot of growth-related stocks, whether it was the domestic market being down over 30%, if it was the international market, they were down about 16%, and the value portion was down probably about half of that. In some areas doing a lot better. So value outperformed growth last year, and we're likely to see that continue for some time as the value-related, value-like stocks kind of catch up to the valuations of growth. Next, we have emerging markets, and I'll show illustrations for both emerging markets and small cap. Basically, based on valuations, these areas are more inexpensive relative to other areas of the market, and almost historically so. So those should be asset classes for consideration. And then the third item, which not a lot of people commonly talk about, are some of the alternative asset classes that can be added to the portfolios to help smooth out volatility over time and ultimately have a better risk to reward ratio for the portfolio. And really what we saw is if you did have exposure to managed futures last year, to commodities, that those were two of the best performing asset classes last year. And one other that we actually added to the portfolio last year is merger arbitrage. And that's a type of strategy that is not dependent upon interest rates, such as fixed income. It's not going to be as dependent upon valuations in the market, because that is a strategy that will find companies that are acquiring another company. So the example that I like to use is when Amazon purchased Whole Foods. What a fund strategy like merger arbitrage will do is they will purchase a company like Whole Foods that is being acquired, and they will sell short the company that is the purchaser, such as Amazon. And over time, as the deal closes, they will be able to have a small profit from that difference. And any of the excess cash that they have set aside to invest in these deals will then be invested in some type of money market fund, where the money they're not using is being able to now earn a more attractive return on that money. So it's really just become more advantageous to have a fund like this in the portfolio, where really for the last decade, the returns weren't as attractive just given the environment. So there's really a variety of alternative asset classes that can really add value, especially when we're having a lot of volatility in the equities market, in the debt market, and for some of the expectations that we have going forward. So this next slide, a lot of our clients will recognize this, and you don't have to pay any particular attention to too much of the detail. I know it's very noisy, but what I want to have you look at is the returns for 2022. Now, this is a list of debt or fixed income investments, so what we traditionally consider as safe, and it shows what the returns were for last year. Now, these are part of the research that we review on a daily basis, really this and several other sheets that show different asset classes and some of the underlying investment options. And what is really interesting to note, and we saw this before, was the returns in 2022. And if you just go down this column, you can see nearly everything is in the red. with negative returns for the year. Now, in general, the Barclays Ag, which is a general benchmark for fixed income, was down 13%. So that's kind of a good average to use when looking at the bond market for last year. But what this was really was a 4 standard deviation event. It was one of the, if not the worst bond market year in history. And since interest rates are now much higher, we have a better base for fixed income. And I'd like to give you a few examples of where we're seeing opportunities. So when we looked at income last year, we were heavily allocated to floating rate funds, which were one of the best performers, actually the best performer for bonds last year. Two of those examples are the Eaton Vance floating rate fund and the Guggenheim floating rate fund. You can see that while most of the market was down roughly 13%, they were down 0 to 2%, and that was a pretty good return for last year. Now, we reduced our exposure over the course of the year and started to add total return bond funds, which is, if you think more of a diversified bond fund that could have exposure to treasuries, corporate bonds, maybe high yield, maybe some agency mortgage-backed securities. And those types of funds we did not have in the portfolios for really the first 6 months. Over the summer, we started to add to those. And really what we're seeing is one of those examples is the PIMCO Total Return Fund, where you can see it had a tough year last year, but this year they're set up to have a lot more success. And part of what we look at, one would be the SEC dividend yield. So just to give you a few quick numbers, for the floating rate funds, right now, those are yielding roughly 7.5% to 8.5%, which is certainly attractive. You know, if interest rates continue to increase, these won't be affected as much. We would just have to make sure the credit quality is good if we were to enter a recession, and both of these funds have been strong performers. On the other side, as we have diversified our bond exposure, the total return funds are now yielding in the neighborhood of 4.5% to 5.5%. And that's a nice coupon to receive, because what will happen as eventually, once interest rates start to drop, you will also experience capital appreciation in those funds. Since interest rates drop, and for bond funds, the prices will increase. So those factors really make for a better environment for fixed income. And even if you just think about typical money market funds today, if we looked at a year ago, they were yielding 0.15% is what we were getting in January of last year. This year, I looked up this morning, we're actually having a return of 4.27% in one of the money market funds that we use. So as a base for putting your cash there, it's certainly attractive and creates an opportunity for this year. Now, the next slide that we have, this is to help shed some light on international and emerging markets. This in particular is comparing the international markets, the foreign markets, versus the US markets. And really what we see is that this chart is from Luthold. It goes back since '73, and it gives you perspective in terms of, on a relative basis, whether the US markets are more expensive or the foreign markets are more expensive. So what we see where we're at today is that even with the decline that we saw last year, we're still throughout history at one of the most expensive points in time for US equities. And that was similar to what we saw on the GMO charts. So what that should really make you think about is, and we'll touch upon this at the end of the presentation with a few of the tools that we have for you, but how much of your portfolio is currently in the domestic markets that on a historic basis are still relatively overvalued, especially in compared to foreign equities. The next slide I have here, also from Leuthold, is now focusing on emerging markets. Now keep in mind, emerging markets tend to have more volatility inherent with them. They have less stable economies, but they have a lot of attractive growth numbers for the future, just with age populations that are a lot younger and more potential for growth. So really what we see here is a price to earnings ratio, which is a tool used to identify the value of a stock, or in this case, a market as a whole. And we can see that the numbers dating back since 2000 kind of show you when the emerging market kind of basket was overly valued, when it was undervalued, and this is during the Great Recession. And then over the next 10 years, it didn't perform quite as well. And what we're seeing right now is it's at one of those points in history where it's at one of the more attractive valuation points that we've seen. So that is another consideration when you're trying to find different asset classes to invest in, or even if you index, if you're trying to find the right areas to shift your portfolio to, you at least want to take into consideration what the valuation levels are for those respective asset classes. And then from here, this is the last illustration for some of the opportunities. And this in particular is the small cap relative to large cap stocks. This is another chart from Leuthold, and they did a great job identifying over the past several decades what the valuation for small cap stocks were relative to large cap stocks. And really in this bottom area, this is showing when small cap stocks are cheap on a comparative basis. And up here, this is when they would be expensive and have a higher price to earnings ratio relative to large cap stocks. Often what we will find is that a lot of mutual funds or a lot of portfolios that we evaluate will be heavily skewed towards large cap stocks. So what we've done over the past 6 months is we have evaluated our exposure to both small cap and mid cap exposure and made sure that we had a proper weight in that area, just because right now it is at a point in time where the future expected returns are higher for those areas, and for growth, they are lower. So on to the next slide. So after hearing about some of the financial conditions for this year, and then learning a little bit more about some of the opportunities that are presenting themselves just purely from a valuation standpoint, I know what you're asking yourself is, well, what does this mean for me in my portfolio? And what we'd like to talk about are 2 tools that we use at Legend and Emerging Wealth for helping prospects and helping our clients better implement some of these items that we talked about. And the first is Riskalyze, and the second is Morningstar. With Riskalyze, that is a software that we use to be able to gauge what level of risk that you're comfortable with. A software and a service that we use from Morningstar. Now, this isn't the Morningstar.com website. That is something different that we also utilize. This is an advisor workstation report. And this, interestingly enough, this is actually half of one page in a report that's over 50 pages in length. So it gives you both the high level, which we're going to briefly review right now, and just show you 3 areas to be aware of and really give you insight in terms of how we try to find those potential pitfalls and also make additions to the portfolio, changes to the portfolio to implement some more opportunities for our research and for our analysis. So 3 of the items that we look at. One is regarding the sectors. If you recall from the beginning of the presentation, what we saw is that there were certain segments of the economy last year that did really well, such as energy. There are certain segments that did really poorly, such as large cap growth, which largely was technology. So with this portfolio, if we were to evaluate this, there would be some red flags right off the bat in terms of having too much exposure to technology and not enough in other areas. And we actually went through a similar process with our portfolios at the beginning of last year and made changes throughout the first quarter, just because over the past decade, technology had performed so well that it was overweight. So for us, this is an area of opportunity to make some changes. We also look at where the exposure is internationally. So you can see that there's this map up here and it shows the world regions. In to mention, this is the equity portion of the portfolio that we're talking about on the right-hand portion of the screen. And with this in particular, we can see the shaded area is in North America. So you have over 96% exposure to the US and Canada, and you have smaller amounts of exposure, some to developed markets like the United Kingdom and less throughout. And as we just reviewed, emerging markets and international markets right now do have more attractive valuations. And it doesn't necessarily mean it's the right time to jump in right now, but it is something to be aware of. And over time, we'd like to see this number be reduced just to be able to have more exposure to other areas that have more attractive valuations. So that's the second part. The third part, and kind of the final part for at least this slide, is we will look at this box called a style box, and this gives us a breakdown of whether or not the portfolio is more invested in large companies, mid-sized companies, or small companies. So you can see those words right here: large, mid, and small. And then it also goes a second step of identifying whether or not those are value-oriented, a blend of value and growth, or growth-oriented. So for this portfolio in particular, we can see that for large cap growth, nearly 60% of the exposure is there. It's also part of the market, if you recall from the GMO forecast, that has the lowest future returns over the next 7 years. In general, the vast majority of this portfolio is all in large cap stocks. So you would potentially be missing out on more attractive valuations in the small cap area that we recently discussed. And that small cap area right now has a discount of about 29% relative to large cap stocks. So this would be another kind of red flag for us, but also an area of opportunity to see what potential changes could be made. And the next one I will show is more of what an ideal allocation would be. And this is just an example of a 60% equity, 40% debt portfolio. And it just shows you a little bit more if we look at the sectors. it's a little bit more balanced. As we can see, technology is just over 20%. If any of these areas were 20 to 25%, that is when we would have to have a discussion to see if it makes sense in the portfolio. Because once it starts to get so large, if one particular sector does not do well, it has the ability to bring down the rest of your portfolio. So this is more evenly balanced, and that's what we like to see. The next part, if you recall, is the international exposure, and we typically like to see it more towards the 90% in North America, where over time we may look to increase to emerging markets, depending upon what happens with the US dollar. So that's something that we're monitoring on a weekly basis. And from there, almost just as important is looking at the sector breakdown. So we can see that for the large cap portion, we have roughly 43% in large cap, and then approximately 30 in each of these, the mid cap and the small cap area. And you also notice that it tends to be relatively blended. So for last year, value really outperformed growth. Really in the decade beforehand, growth was the big outperformer. So it should help you have more diversification, and it'll ultimately help returns over a longer period of time. So really to summarize, fixed income relative to a year ago is much more attractive. When we have money market rates that are yielding over 4%, it creates a great base for fixed income to be a better investment for 2023. For equities, valuations have certainly improved when we're looking at valuations compared to 1 year ago. However, historically, they tend to be highly priced, and there could be more volatility ahead depending upon what goes on with the economy. So what happens with interest rates, continued improvements in inflation, how corporate earnings are affected, and ultimately whether or not we actually do have a recession. And from there, the other category is something not to forget, especially when two of the asset classes that were the best performing asset classes last year were managed futures and commodities. And there are others, such as gold, that have been performing well. Merger arbitrage, which I mentioned, which tends to be a more unique asset class, but certainly one that warrants attention in this type of environment that we're experiencing. And from there, really just trying to offer you a few different alternatives for tools that you can use with the Riskalyze service for finding out your risk score, and then also for any prospects interested to find out what their portfolio looks like. We'd be more than happy to run your portfolio through the Morningstar Advisor Workstation report and give you a better idea of what it looks like for you. Now with that, I'm going to go to the Q&A, open it up for questions, see if we have anything that our listeners want to ask. And I know one of the questions that we've had frequently, really over the past 1 to 2 quarters, is since interest rates are now higher, they range from 4.25 to 4.5%. More prospects, more clients, really anyone, are starting to get more offers, whether it's CDs or annuities. And that's been one of the areas that we've had a lot of questions about. And what we found interesting so far is when it comes down to a CD, for example, you have to take into consideration the time frame that the amount of money would be locked up for. So whether that's 6 months, a year, 2 or 3 years, the rates now look more attractive since rates have gone up. But what we found to be even more attractive are really the money market rates that we found in today's market. And so, for example, with one of the ones that we're using for our clients, it's yielding about 4.27%, and that's updated as of this morning. And most of the rates for CDs that we've found are not above that rate. So you ultimately have a money market fund that doesn't charge you anything to purchase or sell, that you can buy one day and sell the next day. So the liquidity is great, and it has an attractive return. So for our clients that have wanted to park some extra cash, whether it be for an emergency reserve or just keep some cash on the sidelines, that's been an attractive area that we've found, and more attractive so far, given what we've seen from CDs so far. Okay, another question we have is regarding annuities. So annuities is very similar to the question with CDs, and annuities are now becoming more popular just because rates are more attractive, and really it depends on whether or not it is the right fit for you and your situation. A few items to keep into consideration include the underlying fees associated with the annuity that tends to be on the higher end. Also, with annuities, it depends whether or not your assets are taxable or mostly non-taxable. So it'd likely be a more attractive option if most of your assets were taxable. And the other part is not necessarily wanting to lock in a certain rate, as we're in an environment where interest rates are likely to continue to rise, most likely in February, and then potentially after that, the Federal Reserve is anticipating a second increase this year. Another good question that came in is regarding the safety of money market versus the FDIC savings account. And so the FDIC savings account has a certain amount of protection, and I don't have that number off the top of my head. But I know we custody through TD Ameritrade as well as Pershing. And for the money market accounts that we are using with both custodians, they have a certain amount of insurance, which is a very large number in case there was any issue with liquidity. So it's something that in the years of the financial crisis in 2007 to 2009, there were some minor cases, but what has transpired after that is now custodians have more insurance in place in case there are any issues when it comes to liquidity with money market accounts. So when we made the change, over the past three to 4 months, I would say, that was research that we did, and it wasn't something that was of concern to us, just given the amount of insurance that both of the custodians have to be able to account for any potential losses. That's a great question. Another common question that we have, and I'll have this be the last one for the presentation since we're at 1 o'clock, is the question of paying down debt. So we've actually had this conversation a few times recently with clients. Now that the servicing of debt is much more expensive than it was a year ago. A home equity loan as an example. Typically what we've seen is to have an even pace for paying off the debt is helpful, but you don't want to have a too substantial withdrawal rate from your portfolio just to pay off a large portion of debt. Because ultimately what you're seeking to have in a portfolio is a return of the portfolio that will outpace not only inflation, but any debt that you currently have existing, whether that's debt on your mortgage or alternatives. So that is something that we've seen that we think it still makes sense, but it depends on the client. And but that's a good question. All right, so with that, thank you everyone for joining the presentation. And I will turn it over to Dan to finish out.
Okay, great. Thank you, Bill. That was a lot of great information today, and I want to thank everybody for joining us for the webcast. If you'd like to schedule a free conference call consultation with a member of our advisory team, please call our office at 412-635-9210 to set up an appointment. Thank you again for attending, and this concludes the event.